How do you get a buy-to-let mortgage? Welcome to Property Investing with Abi. Today I'm so excited. My finance broker that helps me finance all my deals, I've managed to convince him to come on for us for this YouTube episode and give an interview. So we've got him coming on. He's on a platform called Zoom, so it's video conference because he lives in Wales, in the valleys. Not in the valleys, but in Wales. And it was a bit of a trek down for him, and we really wanted to do this episode. So he's on the laptop, and we'll get started and ask him all the questions that you guys want to know. Now, Joel, we've worked with Ramsey and White since the summer, and they're one of our number one finance provider for all our property deals that we do. Now, the reason why I asked Joel to come and join us on the YouTube channel today is to talk about some myths that are in the property world and how easy it is to get finance. So this is part of our buy-to-let series of buying houses, and you guys know that I like to buy houses with cash. I like to refurb them, and I like to put a mortgage on. And that's where Joel and his team come in very, very handy, because they're the point of contact when I call when I need a mortgage. So thanks so much for being on with me today, Joel.
Thank you, Abi, for having me today. It's a pleasure.
Awesome. So the first thing I always get asked when I'm at Touchstone events is how easy is it to get a buy-to-let mortgage?
Okay, so the good thing about the buy-to-let market at the moment, it's very competitive. There's a lot of lenders in the market. There are a lot more rules and regulations now in 2019 than before, say 2007. So I think it's about working with the right people to secure the right finance. But yes, finance is very much available. There's a lot of liquidity in the market, which is good news for borrowers, and the rates are very competitive at the moment. So it depends on what you're trying to achieve in the property world. It depends on which lender you're going to use, but funds are available. So yeah, it's easily accessible at the moment, yeah.
So when I first started property investing, Joel, the only thing I knew is my own little house mortgage that I got, residential. When I went to my bank, NatWest it was, and got a mortgage. So how different would you say is people getting the normal residential mortgage to buy-to-let mortgages?
So when we look at residential mortgages, property finance, the lenders are going to be looking at your personal income and expenditure to offer you a maximum loan. And when you look at buy-to-let mortgages, then it's done on the rental income, which will offer you the maximum loan. And also on residential, you might be looking at loan to values at 85, 90%, whereas typically on a buy-to-let product, it is 75% loan to value. There are lenders that will go higher, 80 and 85 in some lenders, but majority is around 75%, so you normally need a little bit more of a deposit to get into the deal.
I always wondered why that was. Why is it that they want more for... They're happy to take less deposit for your own house, but they want more for, your buy-to-let portfolio?
Yeah, so again, it comes down to your personal circumstances. So you could look at your residential, your personal income and expenditure, and they will get more comfortable with you being on a capital repayment loan and offering you more money towards that. It's more secure. Whereas an investment, you're not going to be living in a property, you're having tenants in there may be void periods, you may be taking on interest only. So although they want to lend, they just need to mitigate that risk, and they feel that, before the credit crunch, there was lenders offering 100% finance on buy-to-lets.
Wow.
And that left people in a very vulnerable position.
Yeah.
And a lot of people lost their portfolios. So now it's about lending more responsibly, and that's why the lenders, you'll see more lenders around the 70, 75, 80% loan to value on buy-to-lets.
That makes complete sense. Thank you. The other thing that I get asked a lot is because at the beginning of this series, I talked to my viewers about buying into a company and how it can ring fence you. Yeah. And I always believe in buying properties into a company. And one of the biggest reasons is Section 24. And a lot of people ask me, can you actually get a buy-to-let mortgage if you're buying a property in a company?
Yeah. So to answer your question is yes. A limited company effectively is just a tax wrapper. So a lot of investors have moved into buying properties or transferring properties into their SPV, single purpose vehicle, or limited company structure, just to make it more tax efficient for them. So lenders understand this. What they'll want to see is that so effectively you could have a company set up today, as long as there's an associated bank account with that, a business bank account, and the limited company is set up for buying and holding properties, then there's no reason why you can't get finance for that company. What the lender will do is look at the directors and shareholders behind that company to make sure they meet the lender criteria. And if you meet the lender criteria and the valuation stacks up, then there's no reason why that company can't secure the right finance for their buy-to-let.
Perfect. The other thing that people ask me is, what if my company's only been open a month and I haven't got any money going for it because it's not trading, it's just for buying property. So I'm on a good salary, but I've just set this brand new company up. Can I still get a buy-to-let mortgage in a new company?
Yeah, so again, the answer is yes. So we have a lot of clients who have good employment, very high earners, and they're looking to offset some of that income into a property business, and therefore they set up a company structure to acquire property. So that company has no experience. So as long as the company's been set up correctly to buy and hold property and has a bank account associated with that, the lenders will just look at the director or shareholders or both behind the company and just make sure that they meet the criteria. So it might be their age, their income, the property value, the tenant type. So there's a few boxes to be ticked, but effectively the company's just a tax wrapper. So as long as the other boxes are ticked, then there's no reason why that company can't secure finance even without any trading history.
Perfect. And that's really good for our newbies just getting started. We talk about buy-to-let mortgages a lot, and I use buy-to-let mortgages, but I also use commercial mortgages. What would you say is the main difference between a buy-to-let mortgage and a commercial mortgage?
So buy-to-let mortgages, you are buying a property to rent out on a single AST. That might be 6 months, 12 months, 24 months. To maybe a family or single member. So a commercial mortgage, there's no reason why you can't have a buy-to-let property within a commercial, on a commercial mortgage, but a commercial product normally set up for commercial property, or say for example it might be a property that is trading business, or might be retail shops, or it might be mixed use. Or, for example, serviced accommodation, short-term lets. You might build a portfolio of serviced accommodation, and a lot of lenders in the commercial space will offer the commercial products for that. There are some more challenger banks now offering products in that space, but the main difference is the company structure and the type of property that you're acquiring.
And is it true that commercial look at more income-based for lending rather than the bricks and mortar, or is it both they look at?
If you're looking at, for example, HMO, then say it's 7 beds plus, and you're looking for a commercial valuation, then there's something called a long report versus a short report. So the long report's the red book valuation, it's a lot thicker, a lot more detailed, and the short report is a bricks and mortar valuation. So the commercial valuation will look at the income that property can produce, and it's more like a yield-based valuation. If you're looking at serviced accommodation, with the challenger banks, you might be looking at, on the smaller SA units, kind of bricks and mortar valuation based on the single AST rental income. If you're looking on the larger scale SA units, like you might have a block of flats, then they will take into consideration there's something called the EBITDA, which is a business calculation, which works out the profitability of that building and from the rental income it can produce. So you might be able to get a higher loan based on them properties versus a kind of a bricks and mortar valuation. So that's where it comes. But if your property doesn't fit that mould or the type of tenants you're looking to get, then we'd recommend taking maybe a bricks and mortar lender because the rates might be slightly cheaper. So it depends on what you're looking to do, but the commercial lending can allow you to do bigger deals and attract more properties in the commercial entity.
Yeah, and I suppose that's the great thing about having a broker, isn't it? Because I don't know all the finance products. I'm not an expert. I just know I like buying the property, which excites me. But getting the finance raised on it, I prefer to leave it to experts, and that's the best thing about having a broker, isn't it? Because I can ring you and one of your team up, tell you what I've got, and then you advise me what I could have and what might be the best for me.
Yeah, exactly. I think over the last 15 months we've submitted 42 million in mortgage loans specifically for property investors across the UK, and every case is slightly different based on the investor's circumstances, the type of deals they're doing, their experience, their income in the background. So we have to tailor the fact that the solution to that investor's need. So we'll always run through a fact find out what they're looking to achieve, in what sort of time frame, might be 6 months, 12 months, 18 months, and then work with the right lenders to facilitate the type of deals you're looking to do. So we kind of see ourselves as a finance arm to property investors. They're building when they're building their business. So for example, you're building a very successful property business, and we just want to make sure that you've got the right finance to support that business, and not only that, but build a robust portfolio that has longevity. So it's important that we give you the right advice, and we're speaking to lenders on a daily basis because the market's always changing, products always changing. So we want to make sure that you've got the best possible product to meet your needs and requirements.
And when is it best that somebody contacts you? Is it best that they contact you before they've actually bought the property to check things, or are you better leaving it until they've got the property and they're now wanting to pull the money out?
Yeah, so it depends on what the investor needs. So you might have a brand new investor to the market and just needs information about the buy-to-let, HMO, service accommodation or commercial conversions, that type of finance, and we would just talk them through how that works, just to give them a bit of education and understanding of what may be possible in the finance market. Then they'll go away, do their research and find a deal, and then they'll come back to us. We might have an experienced investor who has multiple offers on the table, and then they'll contact us and say, look, I've had offers accepted. What I would say, if you are in the market for buying a property and you've had an offer accepted, before you instruct a solicitor, then speak to your finance broker, because depending on the solicitor, or depending on which lender you go with, every lender has a certain panel, or has a panel of solicitors, and it's important that your solicitor is on that panel, because what you don't want to do is pay solicitor costs and then have to change solicitors because you're using a lender that doesn't allow for that solicitor. So it's sooner rather than later, I would suggest. And also, if you're buying at auction, then you may have 28 days to exchange and complete. So you want to talk through that deal with your broker and make sure that you can get the finance agreed before that hammer goes down, so you're in the best possible position to give you the confidence to exchange contracts with knowing you've got the right finance in place.
Definitely. And that's such a good point, isn't it, about the solicitors, because I've been stung by that. Been with my solicitor's not on the panel, and then I've had a bit of a nightmare trying to figure out another solicitor and get another solicitor to do the deed, and then it costs you more, doesn't it?
Yeah, no, absolutely. We've all been there. I think all the advisors, including myself and Ramsey and White, we all invest in property, and it's you're constantly learning in property, and it's about having the right team around you, the right people to advise you and put you in the right direction. So as your business progresses, you'll learn more and get the right contacts and get the right finance and right lending in place.
Yeah, the thing that I love about you guys is, obviously, I got in contact with you in the summer because, and this is the thing that I tell people have their own mortgage broker that they like, and usually it's the mortgage broker that did their own home mortgage, but they're not a property investor and they don't understand some of the things that can happen. So, and I say to people, don't, go to a proper property broker. That's what you need for finance. But I'd actually gone through 2 different brokers. So I bought a house cash, refurbed it, and I wanted to get the finance. I wanted to put a mortgage on it, and I wanted to do it within 6 months. So I went to 2 different brokers who kept telling me, because the value of the property was under 60 grand, that it couldn't be done. And then on August bank holiday, Paul, who works for Ramsey and White, answered the phone to me. Such a lovely guy. He was Welsh. He got a tick in the box straight away from me. And he was so lovely. And you guys managed to get us a mortgage. And I think we had that money a couple of months ago that came out, which was great.
I think, Paul's a great guy. He's also a property investor, qualified mortgage advisor, so very experienced in commercial and residential finance, and helps a lot of investors and overseas investors here in the UK. So, taking it back a little bit, when I got into buying my first buy-to-let, I was working as an estate agent, so I knew how to find a deal, knew how to negotiate a deal, I knew about working with solicitors, but I didn't know about the property finance. So I got recommended a mortgage advisor, and he was really old school. He was still smoking in his office, he slicked back hair, and he said, leave it to me and I'll take care of it for you. And I said, okay. Now, actually, in hindsight, I could have had a better product, a better service. He didn't really understand my strategy, the buy, refurb, refinance, and I ended up with the wrong product, and I was a bit naive, so I just went along with what he told me to do. So I thought, well, if I'm going to invest my own money and potentially other people's money in property, then I really need to understand leverage and how the banks work. So that really pushed me to go and understand the market, research, get qualified, and then eventually go into commercial brokerages and learn the ropes of, service accommodation development, buy-to-let, HMO, commercial, and buying through limited companies and portfolio acquisition. So I would tell the guys in the team that remember why I set up this company and got into property finance is because I didn't have that good experience, and I wanted it, and I needed that knowledge, and we need to give that to our clients and investors, and hopefully we'll have a successful business off the back of it. But I really enjoy what we do, and I'm grateful that we have the opportunity to work with people like yourself, Abi, and other people within your network.
Yeah, and I think the feedback from the whole of Touchstone is Ramsey and White is so easy to deal with. And what I also love about Paul in particular as well is if I want to do something that cannot be done, he'll tell me. Instead of just, just taking me through, making me fill out paperwork and then the lender be the bad guy saying no, Paul will be very straight with me and go, you can't do that, Abi, but here's a different option that you could do. And that's what I really like, where I've spoke to other brokers in the past and they've gone, yeah, you can do that. I've paid their broker fee, gone forward, and the bank's like, no, why do you think, you could never have done that? I've never got but I love that you guys are so honest. Even if it means no business for you, you'll tell us, straight.
Yeah, I think the main thing there is that for us, we're in this for the long term, so it's about building good, credible business relationships with all our customers, including yourself. And if we don't give you the right advice, or we just take money and don't get you the right deal, then you're going to find out now, you're going to find out later and speak to another advisor or solicitor. So it's about giving you the right advice, and if that means we don't win in that situation, we still win because we're giving you the right advice, and doing the right thing, and hopefully you come back round to us in 6 months, 12 months, or whenever you have your next deal.
What would you say to people that are watching right now and they're thinking, I want to go and do my first one, or I'm a bit frightened, what if I put all that cash in and I can't get it out? Because it's fear, isn't it, that stops people, and we talk about this a lot. What would you say? What got you to do your very first one with all the fear and doubt?
Yeah, I think like lenders want to lend, but they are very risk averse as well. So they try and mitigate that risk by putting an application in place, a valuation in place, and ask all these questions, and it can be very frustrating. But actually, as an investor, what I would suggest is always do your own due diligence. And if someone gives you some advice, then do some due diligence on that advice, and always clarify where that information's come from. So, you could get given a property from an estate agent you've been working with for a couple of weeks or a couple of months, and they've told you, it will sell for X amount of money. So you need to do your own market research on that. And I think if you do your own research and due diligence, so speaking to local surveyors, local estate agents, local solicitors, local finance brokers, local investors within your network and community, you can gather confidence that a deal is going to stack up. And I think what's really important is that you treat it as a business, and you don't get too emotionally involved, because sometimes you can get emotionally involved in the deal and you start manipulating the numbers and making it work because you really wanted it and you've been working hard and you want to build this portfolio, but so you're pushing it to work, but actually the feedback you're getting is it doesn't really stack up. It's not hitting the metrics that you set yourself when you set up the business. So really you need to look at a number of deals so you can go, okay, I'm going to move away from that one and bring this one into the pipeline, which actually meets my criteria, is going to help me long term. So I think just mitigate any risk, and you're always going to learn new things as you go along, but as long as you can reduce the risk as much as possible by getting the right finance, speaking to the right solicitors, speaking to the right selling agents, and that gives you confidence.
Well, thank you so much, Joel, for coming on. What we'll do for everybody that's listening is we'll put the link for them to contact you guys down below. So if they want to find anything out. Also, in the Touchstone Education community group, Paul, who works for Ramsey and White, is always in there posting stuff and talking about stuff. So definitely contact Ramsey and White either by the link below or through our Touchstone Education community Facebook group. But thank you so much. I think that's been so useful for everybody.
No, I really appreciate your time, and I know you've had a great year, and I'm looking forward to seeing how that progresses in 2020, and look forward to working with yourself, Abi.
Thank you. Wasn't Joel amazing? And honestly, Ramsey and White are one of the best brokers that I've found. And they're so lovely. And answering on a bank holiday, which finance brokers do you know does that? They're really lovely guys, down to earth, and they're very effective. So huge thank you for having them on. So I hope you've enjoyed today's episode. Please give the video a like, comment below, and especially comment if we've not answered a question that you're thinking, because I'm sure we can get Joel to come on and answer some questions in the comments box. So next week, we're going to be looking at a repossession. repossessions. How do you buy repossessions? What do you need to look for? So join me next week with Property Investing with Abi.